Hello, all. Josh Pick, Aptus Wealth Management. Today we're talking stock market crashes, particularly stock market crashes and what it's like to be an advisor during a stock market crash. I was having dinner with a friend the other day, and here we are in the end of September 2022. S&P 500 year to date is down a little over 23%, and he says, "Wow, must be tough for you these days. How are you fielding questions?" And I think it really points to a bigger issue, and that is, as investors, not even just advisors, but as investors, we're kind of our own worst enemy. We like to think, and I've had this conversation a million times, we like to think that we put the blinders on, we understand that the stock market is going to go up, it's going to go down, there's going to be volatility, and we just need to stay in the game to win in the long run, because we all know that in the long run, the stock market and the virility of the US economy and the world economy wins. That said, it's awful darn hard when you have $1 million one day in a very short period of time, less than a year, you've lost hundreds of thousands of dollars. So, we'd like to think that otherwise rational people won't do irrational things. But I've had conversations with people ranging from doctors to finance professors. We're talking PhDs in finance to, the average consumer about what do we do now. And although we all know that market timing is a terrible idea, the first word out of people's mouths when they start losing money is, "I can't lose anymore and we need to go to cash." I think we think oftentimes about buying low and how do we get in through market timing low, but selling out when it's low and going to cash is the exact opposite of that. And we all know that, but we start telling ourselves things like, "Well, I can't afford to lose anymore." Or, "If I can just get out now and it falls another 10%, then I'll buy in then and I'm better off." But let's think about some historical perspective and the realities of what that would mean. Number one, market timing never works. And if it does work, it's very fleeting. You might be able to make $1 here or there along the way. You might even have some success. And sometimes that's even more dangerous if you have success in spite of yourself, because you start gaining confidence that you shouldn't be gaining, and then you make bigger problems for yourself. But let's think about, the market as a whole. I start hearing things during times like this, like it's going to crash and go to zero. If you look at the 30 largest companies in the world from 40 years ago and you look at them today, the valuations of those companies and how big those companies have got, if you said at the time that we would have companies worth trillions of, if you went back to the 1980s and say, we're going to have companies worth multiple $trillion, there's no way. And yet here we are. If you look at stock market crashes along the way, think of 08, 09 during the financial crisis, think of 2001, 2002 during the dot-com bubble, think of 1987, which was Black Monday. In 1 week, the market lost over 30%. And then fast forward 10 years from that. I know it was a difficult time, caused heart palpitations. You went from 1 million down to, let's say, 600,000. But then 10 years later, in almost all of those instances, your million that went down to 600,000 was probably worth somewhere around $2 million. And this points to a lot of studies where investor behavior is almost more important than the investments that you pick. Simply having good quality investments and leaving them alone is probably your best choice. Matter of fact, Warren Buffett speaks to this. He says, somebody said, "What's your average holding period of a stock?" He said he always goes into buying a stock with the holding period assumption that he will own it forever. You think about studies like the Fidelity Magellan Fund, which averaged, over 20% for a really long period of time, but the average investor inside of the Fidelity Magellan Fund averaged something like 4% because when volatility picked up, they got out. When it got better, they got back in. They were their own worst enemy. You look at the S&P 500, it's average, and then the average investor is only earning about half of that. Matter of fact, I remember an interview, I believe it was the Harvard Endowment Fund, which is one of the largest endowment funds in the world, was interviewed, and obviously smart people over there at Harvard. They said, what is the most important thing that you could tell, or what's the one thing you could tell investors that would improve their performance? They had to say, again, I might be speaking out of turn here, maybe it was a different university, but it was definitely a highfalutin university endowment, said, well, be benign neglect. They got to sound fancy. Benign neglect simply means ignore it, leave it alone, get out of your own way. So to circle back to the question, what's it like during these times? I think it's important as an advisor to be proactive. I think it's important for us to communicate with our clients. Our communication certainly picks up during times like these. But I think it's important to note that simply saying, just hang in there is not enough. I believe that providing historical perspective, like some of the information I just gave you, recognizing that people have fears, and those are very legitimate fears, but hopefully figuring out a way to calm those fears through logic, being pragmatic, and showing that historical perspective will keep them honed in. Now, that does not mean you can save everybody. And as an advisor, you need to know that sometimes people will panic and they will scream fire even though they don't need to. And that is not necessarily your fault. But nevertheless, if you want to achieve your goals, if you're a client or if you're an advisor, you have to keep on managing those funds in accordance with logical principles that over time will win. Don't lose your discipline, don't lose your determination, don't lose sight of the facts, and ultimately, both you and your clients will be rewarded.